Hello, everybody. I'm Keith Gallinelli. I wanted to welcome you to this first in a series of podcasts with Frank Gallinelli about real estate investing. Now, you may not know me, but you've probably already encountered my father, Frank. He is the author of the best-selling book, What Every Real Estate Investor Needs to Know About Cash Flow, and 36 other key financial measures. It's already in its third edition now. He's also the founder of RealData Software, which publishes analysis models for investors and developers. He's taught real estate classes. He's a professor at the Columbia University Graduate School for Real Estate Investment and Finance for more than a decade. And if any of his former students are watching this right now, I am sure he would like to hear from you and see what you've been up to in the recent years. He's also been working on a series of online video courses about real estate and real estate investing. And so there's a lot of things that he knows about real estate, and we really wanted to kind of pick his brain a bit. So, Frank, Dad, you have something in particular that you wanted to discuss today, so I'm going to turn it on over to you.
Okay. Well, thank you, Keith. Thanks for the introduction, and thanks for hosting this. Yeah, I'm sure that the folks who've read my books and taken my courses, use my company's RealData software, they all know that I'm kind of a numbers guy. You know, I'm kind of sort of the quant nerd sort of person who likes to deal with metrics and analysis and that sort of thing. But, you know, I also hear a lot of people ask a very more general kind of bigger picture question of how do I get started in real estate investing? So I did want to do something different today, something that's kind of out of character for me, and talk about how to get started in real estate and using my own personal experience as kind of the vehicle to explain this. Because you know, what I did way back when, I don't think was all that unusual, all that special, but it may serve as sort of a seed starter for people who want to get into real estate investing. So that's where I'd like to take us today.
Okay, well, that sounds good. So I guess, you know, this is actually kind of interesting for me as well to hear the history, because we're going to go back to the beginning of it. Now, you started investing in the 1960s, and you weren't really a real estate investor. You didn't come from a lot of money. You were working as a teacher. And so I think that maybe this is a good point to kind of just start from the very beginning. How did you get started with real estate investing? Because I'm sure there's a lot of people out there right now that are kind of in a similar position. You know, they may be working, they've started paying off their student loans, they've saved up some cash, and they're trying to think, okay, what can I do with this cash? Is it a good idea to put it into the stock market? Should I start investing in cryptocurrency, which may not be the best idea? Or what about real estate? Is that an option for me?
Okay, well, thanks. So you've hit on kind of all the key buzzwords here. I must correct you on one thing, though. It wasn't until the 70s. You're making me even older than I already feel like. Okay, thank you very much. It was the 70s that all of this began. I will go back.
In my defense, I was not there in the 60s or just becoming around in the 70s. So
let me deal with that very issue. Okay, so back in the beginning. Your mom and I were both teachers. She taught Spanish. I taught math and English. We had a little Cape Cod house in Meriden, and everything was going just fine until one day she said to me, "I'm expecting." Guess what she was expecting?
That would be me.
Yeah, that would be you. So I can blame you for most of what happens from that point on, at least in regard to my real estate investing career here. And the reason I say that is because as soon as we realized that you were on the way, we had this nice little Cape Cod house, as I told you, but we're looking at now going from 2 paychecks and 2 mouths to feed to 1 paycheck and 3 mouths to feed. And even though our mortgage was some, ridiculous number, what's ridiculous today was something like $140 some odd dollars. Without that second paycheck, and hers actually was the bigger of the two, we weren't going to be able to deal with this. So we needed a plan B. Okay? So, serendipity. One day, a fellow teacher, a friend of mine, says, I know a guy who wants to sell a big 3-family house in New Haven. Well, we didn't know anything about being landlords or, rental property or that kind of stuff. But 3-family house, New Haven, said, okay, let's think about this. And the reason it wasn't a totally alien proposition is because, well, New Haven was a familiar place to us. Your mom went to college there, Albertus Magnus. I went to college there, Yale. We lived there for the first year or so of our marriage. And my job, my teaching job, was in New Haven. So I said, this is a little bit of an adventure, but okay, let's give this a try. So we bought it and we moved into it. So my first tip to potential newbies in real estate investing is consider the possibility of buying a multifamily house and actually living in it. Okay? That's a way perhaps to get yourself started.
I think that it's important, you were investing in an area that you knew well, that you had a lot of connections to, but even going back a little bit before that, you mentioned that you didn't really have enough money to pay the mortgage. How did you actually come up with the money to start and get that initial investment off the ground? Because just buying a house seems like a wonderful thing, but if you don't have the money to begin with, how do you get started with that?
Well, for that house there, with a little family help and selling our other little house, we were managed to get ourselves into the multifamily. Okay, but now I'm getting interested in real estate, and I want to see if there is perhaps more that we can do, and that's where we kind of got into serendipity number two. After the original good fortune with being able to find the solution to our immediate problem, we encountered another friend who apparently I must have talked a lot about this kind of stuff, because he said, okay, I want to talk to you about investing in real estate. And he said, I've got some cash, I've got some capital I could invest. What I don't have is time. He was a professional. He had a medical practice. I had time, but no cash, because I was a teacher. So I was out on the, out by 2:30 in the afternoon. So we decided that we would form a partnership. And so there's my tip for beginners number two. Maybe you can form a partnership. Now, the one that I formed with my friend here was I contributed what was now my, incipient expertise, if you will. I was learning a little bit about how to operate a real estate, a rental property. I'd learned, for example, that you want to really do the most you can in terms of maintenance all the time, because you can't really expect your tenants to take good care of a property if you don't take good care of a property. So that's one of the lessons I learned. I also found the transition into being a landlord not that bad, because I discovered, this came as a kind of a surprise, but I discovered that people who are real hellraisers really don't want to live in the apartment right above the landlord. So that kind of gave us a little bit of an ease in, if you will, to the process of landlording, because we didn't get, real crazies that we had to deal with there. So I'm kind of getting into a rhythm, if you will, here, learning it. And so when I got involved with my partner, who could put up some cash and I could put up some expertise, that looked like a process that could work. Now, so my tip for newbies number two is perhaps get into a partnership, but you could do exactly the reverse of the partnership that I got into. I was providing what was presumably some expertise, and he was providing some cash. Now, maybe you're in a situation where you have some cash, but you don't really know what you're doing. Partner up with somebody who does know what they're doing. You provide the seed money and let somebody else, put in the expertise, and you put your heads together, and now you begin to form a viable way of doing things.
So now you've got a partner, you've got one property. You were also working in real estate part-time as well, and you started seeing some properties and kind of finding other opportunities. So did you stop with the one property, or did you keep going, or?
Well, that's kind of where I wanted to go with this conversation, because no, we didn't stop there. We really didn't have a plan when we started, but we bought this one property, and it was a fixer-upper, so we fixer-uppered it. We fixed it. And I came up with what I thought was a really clever and original idea. And I was maybe only half right. I might have been clever. I might be able to take credit for the idea of being, clever. But I found out later it was by no means original. In fact, I found out just recently that somebody's even given it a name. What we did from that point on is something called BRRRR. I think I got the right number of R's. B followed by 4 R's. Okay.
So it sounds like something cold. Are you looking for properties in the far northern provinces of Canada, or is this just is an acronym for something?
Yeah, it's an acronym. So let me see if I can parse that out for you. So what we did, not knowing that this was a thing already, was to follow this process, and the purpose of the process was to build a portfolio of cash flowing properties. Okay, and so that's my tip number 3. If you get into it, maybe don't stop with just the first property, but if you're looking to long-term, building of wealth and doing something with real estate that actually has a meaningful effect on your future, on your life, think about ways that you can build a portfolio. And apparently, this has been done by a lot more people than myself. And as I said, it wasn't even original with my partner and me, even though we kind of thought it was.
So your investment strategy is BRRRR, B followed by 4 R's. So
4 R's, yeah.
Okay, so why don't we just go through each one of them, because I think it's important. It is kind of a stepwise process. So the first one is the B, which means buy. So can you explain a little bit what you mean by buy?
Well, yeah, you got to start someplace. So if you're going to build a portfolio of properties, you got to start by buying one. So you're going to buy the first one, okay? As we did, my partner and I, when we bought that small multifamily house. And by the way, no pun intended, you don't have to do multifamily houses, okay? In fact, from what I understand, most people who follow this BRRRR thingy, they do single family houses. So that's perfectly fine. That's perfectly fine. And for many people, that may be easier, more familiar.
Yeah, and so what are your criteria? It seems like you have to have a criteria when you're going to be buying something. Do you have anything to look for in a property that you think would be important for somebody that's just getting into this?
Yeah, there's probably 2 key things. Number 1 is that it's got room for improvement, that the neighborhood, the comps, if you will, all suggest to you that there is a higher level of value than the price at which you can buy this property. Okay, so this property has to be, a little bit, held down by its condition or its obsolescence or whatever, so that you can improve it. The second thing is that it has to be eminently rentable. You have to find a property where people are going to want to rent in this neighborhood. So there needs to be a demand for living in this neighborhood, whether it's living as a homeowner or living as a renter. So those are the things that you have to look for, key things that you need to look for when you're selecting the property to buy to satisfy the first step in this process.
So you did mention that you're going to be buying this and holding it. So we're kind of talking a little bit here. We're not flipping the property, correct?
That's correct. Yeah. This is not. I mean, you can make money flipping. There's a lot of ways you can make money in real estate, and that's one of them. But that's not what we're doing here. We're buying to build a portfolio of cash flowing properties.
Okay, great. Okay, so that's the buy. So you found a property, you realize you can improve it, you realize you can rent it, and then you're going to go on and you're going to have to do something to it. And so What is the second R?
The second R is repair. Okay, you found a property that needs fixing up or needs to be modernized. So the second phase of this process is to repair the property. And it's very closely tied to that first phase, the buy phase, because how much you pay for the property, how much you're willing to pay for the property, is very closely linked to the cost of repairing. Now, there's some conventional wisdom among people who do this sort of thing all the time. And that conventional wisdom is this. And although I promised I wasn't going to get deep in the weeds on numbers, here's a number I got to use, okay? 70%. the amount that you spend to purchase and to repair the property, those two amounts combined should not exceed 70% of what you think the property is going to be worth when you're all done fixing it up. Okay? So that later value, they even have a name for it, ARV, after repair value. Okay? So you want to buy a property where what you pay for the property plus what you pay to fix it up isn't going to exceed 70% of what it's ultimately going to be worth. But keep in mind now that doesn't mean that you have to pay 70%, a purchase price that's going to make 70% your actual number. If you can get the property for less, by all means. Don't be shy at all about driving a hard bargain here. Got to tell you that when my partner and I bought the properties that we did, we didn't get, all emotional about, I love this thing and I need to have it. No, I can recall at least one case where we left our offer on the table for 6 months and we wouldn't budge on what we were willing to pay for that property until the seller finally came back and said, all right, okay, I'll give it to you for that. Actually, I want $500 more than your offer. And said, okay, fine. But yeah. In other words, we held out for a price that we thought was going to be one that would make the deal work. And so you need to keep in mind that when you're doing these repairs, that you really can't exceed a sensible purchase price while you're selecting a property. And speaking of repairs also, the amount of time that you take to make repairs is money out of your pocket because it's rent you can't collect. So you should have trusted contractors already lined up before you get involved in any of this stuff. You should have people that you can call on and you know that they're ready and willing to, to march on in and do the stuff you need to do as soon as you're ready to do the stuff you need to do.
Yeah, from the repair side of things, what do you find are the most commonly, what are the things that need repair or rehab the most when you see a property?
It's pretty much the same kind of stuff you see if you were to buy a single-family house to live in yourself. It's the bathrooms and kitchens that grab people's attention immediately. Refinishing wood floors. I'm thinking of all things that we actually did. And one more thing that we did, on at least one of maybe a couple, we resided the outside. I can recall one house that had this really ancient asbestos shingle siding, and we did vinyl siding on it, and It gave it a whole new life.
All right, and so that's kind of the outwardly visible things, but what about the mechanicals in a house?
Yeah, you can't ignore those. That's for sure. Those are not sexy repairs. I mean, a new furnace. That doesn't. There's no dancing in the street because you just did a new furnace. But do keep in mind that since you're not flipping this property and you're going to continue to own it, that if the mechanicals need to be addressed, you should address them, because if you don't spend it, as part of your repair, then you're going to be spending it as part of your maintenance later on. So you don't want things that are falling apart because you're the guy's going to have to fix them later anyway. So be realistic in terms of what needs to be fixed.
Okay, so we've bought the property, we've repaired it, rehabbed it. The third R is rent. And so let's get into the rent.
Yeah. Well, that was your purpose in getting this property and getting this to be a cash flowing property. So you want to get rent, and again, in the spirit of don't be shy, find out what you think you can rent it for, and maybe even ask for a little bit more than that. You can always come down, but if it's really a desirable property, then folks are going to be probably willing to pay. So rent the property out. Look for good and responsible tenants. Do your homework. It's the same as someone would do to you if they were loaning you money. They would want to know that you have a good credit history, that you have a job, and so on. So be particular.
Okay. Now, maybe just taking one step back. You've bought your property, you've repaired it, you've rehabbed it. What's the kind of the decision-making point? Like, do I flip the property or do I hold it for cash flow? What are the reasons that you would kind of go one way or the other?
Yeah, that's a very good question, actually. your purpose in doing this BRRR business, of course, is to buy more and more properties. And as we're going to talk about in just a second, one of the ways of doing that is to get capital, extract capital out of your existing properties. But of course, another way of extracting capital out of an existing property is to sell it. Okay, and so you certainly can do that. And if you think you have an opportunity to make a home run when you sell it, then by all means do. Do keep in mind though that selling it, you may incur capital gains taxes, so you may not get as much of the proceeds out of it as you hope to. So if you're going to make if it's going to be a real home run, and there's going to be a lot of cash coming out of it, and you don't, and the capital gains tax doesn't hurt that much, then sell it and get the cash, and buy yourself some more properties. But
Okay.
if your idea is to build a portfolio, by keeping the properties, you have an ongoing cash flow. So you had a cash flow with the first one. You have more cash flow. You have two of them. You have even more cash flow if you have 3, 4, 5, and so on. To pretty soon where your properties are providing a regular sustainable income for you. So that can be a good reason to stick with it.
Okay. Well, and I think that leads us into the next R, which is refinance. So you've got this property, you've repaired it, you're renting it, you've got tenants in there, and it's generating cash. And now that you want to find a way to try to get some cash out of that property, correct?
Yeah, that's exactly it. So one of the reasons that you were being as fussy as you were in terms of how much you were going to be willing to spend for the property and what your budget was for the repairs is that you want to leave enough room on that refi so that you're going to extract cash out of the property, cash that's now available for you to invest in more property. That really is the whole point. So when you're looking for a new mortgage, obviously, whenever you look for a mortgage, you're concerned about what the interest rate's going to be. But the other thing to be concerned about is the loan-to-value requirement for qualifying for the loan. It might be worth spending a little bit more on the interest if you can extract even more cash out of the property, because presumably you're going to earn a bigger return on the money you get out than it's costing you in the interest that you're spending. One other thing to kind of be aware of with virtually all lenders, there's what they call seasoning a loan. You probably won't be able to refinance the loan until you've held your existing loan, until you've held that loan for at least 6 months. So just kind of be aware of that. There may be a little bit of time that you need to wait before you can go to the next step. I always used to say, it took me more than 30 years to become an overnight success. So you may take a little bit of time to build up this portfolio.
Okay, good. Well, that's good because it's going to get us to our last R, which is to start the whole process all over again and repeat yourself, correct?
Repeat, rinse and repeat. You got it right. So the idea is that this is a loop. You've got the money out now. You're going to go back to the beginning of the process, and you're going to buy another property, and then you're going to repair it, and then you're going to rent it and refinance it, and then you're going to buy another property, and you're going to rent it and repair it and refinance it, and so on. And hopefully, what you've done after a while is you've built up a nice little portfolio, a nice little nest egg of properties, and that may work for you. But I do want to point out one thing which I probably should have said right at the beginning, and that is there is not one size fits all technique for becoming a real estate investor. Maybe this works for you, okay, or maybe some parts of this work for you. But just as you pointed out when you asked about selling it instead of refinancing it and buying another one, there may be other things that you can do in terms of real estate investing. But what I've tried to do by giving you these suggestions is to give you a couple of tips. The business about moving into a multifamily and actually buying one and living in one, getting involved with partners, building a portfolio like this. These are all things that may work for you and may address the issue of where do I get started? So I hope this has been helpful to some of our folks out there who have, before they get involved in doing the metrics and the analysis and all the rest of the things that I do as part of my regular thing with my courses, my software, my books, and all the rest, that maybe getting this kind of bigger picture of, where can I go to take the first step to get started? So I hope it's been helpful.
Good. Well, of course, I know you're a numbers guy and you've written books on the 36 key financial metrics of anything. And I will be the first to admit I'm probably the exact opposite of you, where I'm not a numbers guy. I'm very emotional. I say, I like this. Let's just go do it. But, I think that it would be good for you to kind of give an example. And I know you have kind of a simple example that we can talk about kind of identifying a fixer-upper and taking that first step. So let's just try to do some of these back of the napkin type of calculations and provide a simple example.
Yeah, I'll try to give one where, we don't even need the back of the napkin, numbers that you can actually do in your head. So let's say that you identify a property that's in a neighborhood of $400,000 houses, but you're not going to pay $400,000 for this. So we're going to work backwards and say, okay, so what's the most that I can have committed to this project? Well, 70% of 400,000. Okay, that means that the most you could commit would be 70% times 400, $280,000. So now you know how much is the all in. That's your limit. Okay. Next, you find out how much is it going to take to repair it. Say for example, 30,000. That way we can subtract 30 from 280. We can do that math in our heads, right? So that leaves 250,000. So when you start to negotiate to purchase this property, you say, okay, I'm not going to buy it for more than $250,000, because anything more than that is probably very little chance of doing the kind of BRRRR, however many R's, that we need to do.
Okay. So why don't we go through the different, with this example, yeah. We've identified a $400,000 property, or this is the area where those houses are kind of selling for. Yeah. We're going to use that ARV of 70%, so 280,000. We're going to try to believe that we can repair things for $30,000. And of course, anybody who's ever tried to repair anything knows that our estimates are usually a little bit lower than it actually ends up costing.
It's for simple math. I'm trying to do simple math. Okay.
And it also depends on who's going to be the one picking the various different things in the kitchen and the vanities. If you're going to start going with all the granite countertops and all that, that's going to get pretty expensive pretty quickly. But we'll just use, for the sake of argument, $30,000 to do that. So, all right, we're ready. We're ready to go. So let's see. That was the buy. Okay. Yeah. The repair was $30,000, and now we're going to talk about rent.
Okay. Well, you want to rent it for as much as you can. I would say if you're looking at at numbers in this neighborhood, it would not be unthinkable to be asking for something like a $3,000 a month rent. You still got to budget that you're paying the mortgage, you're paying the taxes, you're paying the insurance, you're paying the maintenance. But of course, let's say this is a single family house. The tenant will be paying the utilities. So, a $3,000 a month rent would probably give you a substantial cash flow on the property. But perhaps even more important is that it will give you a positive cash flow even after you go to the next step and refinance it. Because if you don't have a cash flow with the kind of debt service that you have to have when you refinance it, you probably won't get the refi. So it's important that you have a good, solid rent amount coming in, so that you have a good, solid cash flow, so that you can go to the bank and look for the refi.
So how did you actually come up with that number of $3,000 a month, using the example that we had? Now, I know I'm throwing you a curveball right now, but
well, yeah, I took a look at what my expenses might be. What my mortgage payment would be, both now and after the refi. I took a look at what I thought my taxes would be. I would have played with some numbers there. Again, probably more numbers than we want to get into here. But the idea would be I want to make sure that after I make reasonable and realistic assumptions of what I'm going to be out of pocket on a month-to-month basis owning this property, that there is definitely going to be money left over for me. And at what rent do I have money left over? More than two nickels to rub together, but enough to say, okay, I've got enough to deal with some surprises, and I've also got enough to cover a higher mortgage payment when I refinance.
And I've been working with you for a long time on building some of your courses, and I know that there's a lot of techniques and there's some software that you've built and some lessons that kind of go over the specifics of how actually to come up with these numbers, because you could just kind of pull a number out of the air, but you may have been missing something that's very, very important in the operating of a property. Like it's not just the fact that you're paying a mortgage and you're paying your taxes, but there's a lot of other things that you have to really pay for here.
Yeah, that's absolutely true. As a matter of fact, one of the things I always remind investors who talk to me who would say, "Yeah, would you mind taking a look at my pro forma analysis?" I always remind them, you should plug in a number for property management. And they say to me, well, no, I don't need to do that because I'm going to manage the property myself. And I say, so that means that your time has no value? Truth is that when that appraiser goes out there, if it's a true income property, and a true income property is usually something that's more than four residential units or is a non-residential property. But if it's a true income property, any appraiser who goes out is going to plug in a value for property management, whether you do or not, before appraising the value of the property. So even if it's a single family house, you got to figure that part of what I need to get compensated for is my own time in doing this. Not just the investment's not running itself. It's not like I went out and bought a stock. I mean, I just have to keep an eye on it to see when I want to sell it. I'm actually hands-on taking care of this property. If I am hands-on taking care of this property, well, that has a value, and it's something I need to factor in.
That's very true. And of course, now we've kind of been renting this. We're generating cash flow, and we want to start getting cash out of this property so that we can repeat the process. And so that's the refinance piece.
Yeah, that's the refinance. So assuming that you've got a good cash flow, assuming that you were not wrong about the fact that this property would be worth what you thought it would be, and assuming that you didn't grossly underestimate the cost of doing the repairs. And so that should pay off your existing first mortgage, which was probably somewhere in the neighborhood of $200K. It should pay off the $30,000 you put into repair, get you back your initial investment in the property. So you have some money there now to invest in your new property.
Okay. And so is this what you did?
Yes, we did it. We did it a number of times. So we didn't do it forever, and it wasn't because it wasn't working out well for us. But sometimes real life gets in the way. So each of us had other things that kind of sent us in different directions and caused us to decide, well, it's time to cash out after doing this for a while. So we did. One of the things that caused me to say, okay, we've got to cash out, is that I was getting involved in some another family business, and we were moving out of the area. Couldn't do the things I was doing, in the neighborhood, managing the properties anymore. So we did cash out, but we had no regrets, and he and I are still the best of friends. This was a partnership that was built on trust and respect. I don't even know if we ever actually wrote down a partnership agreement, but we still remain fast friends, and we go out, with our wives to lunch at least once a month. So the partnerships don't have to be a prescription for disaster. They can be done. That they can work out well if everybody's kind of on the same page.
Well, that's very true. And so you didn't stop just with residential either, right? You started working on commercial properties too.
Right. And that's something I want to talk about in our next podcast, because, what did I do? How did I do it? Why did I do it? And how has it worked out? So that's a story, as I say, for another day. And I hope we can do another podcast. I hope you're willing to host me yet again, where I can wax poetic on what I did, how I did it, and how it's all worked out.
Well, that's great. And if anybody that's listening to your podcast today, that they want to get in touch with you, can they do that?
They can indeed. There are any of a number of ways I can be tracked down. I don't like putting email addresses on anything public because that fills my already overflowing spam box. But you can still send me an email. If you go to our company website, RealData.com, and go under the support tab, you'll see a contact us. And so there's a contact box there where you can send me a message with your email. I'll get it and I'll respond to you. You can also find me on LinkedIn, on Twitter, on Instagram, on Facebook. So, I'm all over the place on social media too. So I welcome hearing from you. I welcome hearing your questions. I'm always happy to help out when I can. And so if you have questions, feel free.
All right, great. Well, thanks for sharing with us today. And I'm actually looking forward to hearing the next part of the podcast and the commercial properties, because I know that also can be very lucrative as well. And well, thank you for sharing today.
Well, thank you for hosting, Keith, and talk to you next time.
All right. Thank you very much.